Hey, everybody. Good to be here. My name is Brent Moores. Time for Advanced Options Strategies. We've been going through this series on advanced options strategies, just various strategies. Each week we're highlighting a new one. This week, callers. Do you ever use callers? Do you ever consider callers? Well, I'm going to tell you why or why not, pros and cons of callers. We're going to do that. And if you're interested in past strategies that we've used in this class and highlighted, check out the playlist for the class. If you're watching on a recording, you can just go to the playlist, go to the Trader Talks channel playlist, and go to this class and look at and you can see the past sessions. I also put a link to that playlist in the I put a link to the playlist in the chat there. I pinned it kind of at the top of the chat. Barb, you can unpin that at some point if you like. There. Speaking of which, I'm joined by Barb Armstrong, helping me out today. Appreciate Barb. She's a great resource. So as you have questions between Barb and myself, we'll do our best to answer those. Also, we're both on X, at Brent Moore CS, at Barb Armstrong CS. Also, make sure you check out Barb's webcast that she does during the week. She teaches a trading a smaller account webcast. She teaches a getting started with technical analysis webcast. She teaches a trading price patterns webcast. Great stuff. Let's go and just talk about the disclosures real quick before we talk about callers. Options do carry a high level of risk. They're not suitable for all investors. The information today is for general informational purposes only. It's not a recommendation of any security chart pattern or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is provided for educational purposes only. All investing involves risk, including loss of principal. And let's see, short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Past performance of any security or strategy does not guarantee future results or success. Okay, and I'll be looking at individual stocks here, doing options on those. Those are not recommendations. They are just examples. Okay, fair enough. Good to see you here. Good to see some familiar names in the chat. That's the S&P 500. We're up over 1% today. So just keeps a little engine that could, huh? Just keeps chugging along. That's what we're doing. At a certain point when things go up, you may get worried about it. Okay. Maybe on an individual stock, maybe on an index. What do you do when you worry about that? Well, there's different strategies to try and help protect you. Of course, there's pros and cons to everything. One choice is always just to exit a position you're in if you think it's going to drop. Say you're in a stock, you may just decide I'm just going to sell that stock if I'm particularly worried about it for a certain thing. Okay. Now, before I get to callers, and we're going to get to callers in a second, I want to follow up with last week's strategy. Or was it 2 weeks ago? We talked about straddles and strangles, long straddles, long strangles. And one of those we did was based on earnings, on AVGO. Now, remember, if you remember with straddles, the expectation is we're planning on a big movement. So kind of the funny thing on this is what turned out with AVGO, and we did two of them. We did AVGO and CVX. But let's just take a look at AVGO for a sec. Well, actually, let me leave it right here and point out something that's kind of odd and not really what I suggested was probably the most likely scenario. Look at what it's doing today and look at what it's doing overall. We had earnings last night on AVGO, okay? And the earnings, I don't even know what the stock is doing right now, but it's down, okay? The stock is down. But previous to earnings, it went up. And so typically what we say is you're probably not going to get that much movement in it before earnings, and then earnings, it's going to spike it or it may dive. Those are the two scenarios that you want. And then that's when the money can be made. Well, what happened is, look, if our PL open right now is 400 and our PL day is 2,300, that means as of yesterday, our PL open was like $2,700 on this trade. And I was actually looking at it like a couple days ago thinking, maybe we should just get out of this trade because we're doing so well and earnings hasn't occurred yet. Well, sure enough, what happened is AVGO was spiking up and then earnings comes out and it drops back down to closer to our original point. It still has moved up enough that we're up on this trade, $440. And like I said, when we went through that straddles session, normally we're just going to exit on those. We're normally just going to exit on those after earnings comes out. Well, earnings has come out. It's a shame we're not making that $2,700 or whatever, but you know what? $430 isn't anything to sneeze at, so to speak. So we're just going to accept that, and we're going to get out of that trade. Okay, we're just going to manage that. Excuse me, what happened? Oh, I had an exit automated on that. So we are out of that at this point here, I think, on that. So we're out on that. That's what happened today on that. We got out after earnings. That's typically what we do. And there we go. I think it hit our target there on that. But I still have, by the way, I still have, by the way, 100 shares of stock underlying that. Okay. Let's go and let's look at the other one. The CVX was not an earnings trade. We still have the straddle on this. And it's going to, we're just hoping this kind of chugs along. And right now we're down about $13 on this. We're just going to be patient on this and go. So I may have been a little off on those numbers there because we do have the stock price, which is affecting those numbers. But the same principle, the principle is we entered back here. We had this nice spike. We're up quite a bit, but earnings actually kind of sabotaged the straddle there on that one there. Okay. So for AVGO, no, the quantity on AVGO, I think was, oh, no, it is still there. You're right. I was looking at days till expiration, George. Thank you, George. You know, folks, what would I do without you? Thanks for helping me out on that. The quantity is still in there. So I'm going to get out of those trades there. I'm going to get out of that straddle. I'm going to right click on that. I'm going to create that closing order, and we're just going to go and get out and take whatever gain we can get out of that. Okay. Now we're out of it. Okay. Now we're out of it. Thanks. I don't know what I was thinking there. Okay. Awesome. So, and CVX, different story. We don't have earnings on that. The stock has just been kind of going sideways, which is why we're down a little bit. Remember, straddles, we want big move up or big move down. This is not the scenario we want, but it's not disastrous. We're down a little bit. We're going to hold on to that. Now, let's move on to the topic du jour, and that is callers. Okay, callers. So as I have done in past weeks in this series, I'm just going to kind of go through the basics of callers here, and then we're going to try and get to some practical aspects, practical implementation of callers. A caller is basically three components to a caller. Three components. Long stock. That's number one. A short call. Okay, that's number two. If I just had long stock and short call, that'd be a covered call. But we also have a long put on there. Okay, if I just had long stock and a long put, that's our protective put on there. Here we have all three for that caller. All three. Those three together make a neutral-ish strategy. I realize neutral-ish is not actually a word. That's why it's giving me that spell check on there, I guess. But I'm gonna call it good for our purposes here. It's not necessarily completely neutral. Depends on what strikes you pick on your call and your put, but it's neutral-ish. Okay. It is not a standalone strategy typically. We're not just going to enter long stock, short call, long put at once, typically. Okay. Typically, instead, what we're going to do is it's used to manage risk. Okay. Manage risk. So remember before I was saying, hey, the market's gone up quite a bit. What if, or do you get concerned about it falling down ever on an individual stock or an index or whatever? Well, this is one of those choices you have. Now, there's other choices as well. You could do a protective put. Okay, fair enough. You can do that. This is, and I'll show you the difference between those two. So typically what's going to happen. So it's typically what we'd say is layered into. In other words, when I say layered into with an option strategy, it means we're not just doing the whole shebang at once. We put in elements after the first elements are in place. So in this case, we're typically layered into after owning stock. So you may evaluate your portfolio of stock that you have a particular concern about. Maybe earnings is coming up and you're worried about it or something, or there's some other event or whatever is causing you worry. This may be something to evaluate at that point. There are pros and cons. One thing, by having a short call and a long put, the Greeks are neutral-ish again, okay? Maybe I'll just put a little space there. And that way, Greeks are neutral-ish, okay? They largely offset each other, my short call and my long put, okay? And Kelly said, for protection in case of a drop, absolutely. That's exactly what the purpose is on this there. What about what expiration date? Well, in terms of expiration date, what we're going to do is we're going to basically, as long as you expect uncertainty. Now, of course, there's always uncertainty. Anything, there's uncertainty, but the extra uncertainty that you feel the need to protect. And you're going to use the same date for both for our caller. In other words, our short call and our long put, same expiration date on those. Okay. The level of the put you choose, the strike price you choose on the put, that represents your protection level. Does the call offer protection? Not much in the way of protection, maybe a little bit. I'll look at that in just a little bit. But the put is really what we're going to call the protection level. The call strike, that represents represents the potential, okay? In other words, if you choose a call strike, you're saying, I'm willing to forego gains beyond where that call strike is that you chose. It's like a covered call in that regard, right? You guys who've done covered calls, you're probably familiar with that. So that's the downside on that. That's that kind of an opportunity cost, if you will. But there are some pros on this as well. Why not just get out of the trade? Well, you maintain the stock. And in case of, say, dividends, maybe you want to continue to gain the dividend, okay? And taxes, maybe you don't want to, there's a tax you don't want to pay or something like that. That you see some benefit of holding that stock, continuing to hold that stock. Because if you have a caller, it doesn't matter that you have a short call and a long put on the stock. You still own the stock, so you're still entitled to the dividend. You still haven't sold the stock. You can get assigned on the short call, but all short options can be assigned early. But there you go. So dividends and taxes are probably two of the main ones that come to mind, I guess, on that. And this is maybe a kind of a restate of number 8, but it caps your potential profit. So after you do the caller and the stock goes way up, you know what? You may be kicking yourself a little bit on that caller because you've limited your potential gains. Okay. When are you going to get out? exit after period of concern or uncertainty, or however you want to say that. For example, let me just put that. For example, earnings. Okay, and I got one more for you that I kind of put down on my list, but there's probably others. We'll try and address those. Oh, yeah. You can exit your call or put independently. Okay. In other words, maybe at some point you just want to say, I want to just turn this into a covered call. You can get out of your long put, and then you're left with long stock, short call. There's your covered call. Maybe you just want to get rid of your call at some point, and you want to be left with the protected put and the long stock. Fair enough. Fair enough. Or you could exit all three, or any, whatever. So you're not stuck. You can try and get out of those. You can always look to exit trades early. Now, that doesn't guarantee the price. There's not a guaranteed market on these, and we don't know what price they're going to be filled. But those are callers, basically. Now, let me address questions, and then let's kind of look at some examples here on this. Mark says, with this strategy, if you get assigned, don't you end up with a leftover long put? So, yeah, so let's say, for example, we got called out on this, okay? Now, typically, we're going to expect to get called out at expiration, but it could be, you can be assigned early. If you get called out, the stock gets taken, the short call gets exercised, you're left with a long put. Absolutely, Mark, you got it. Okay. In the case of if it's in the money at expiration on the put side of things, what would happen? Well, let's think about this. Well, they have the same expiration, so our short call would just expire out of the money. We'd still have that long stock, okay? And then we have the long put coming into expiration. Well, what does the long put do? It essentially sells your stock in that case. So then you'd be out of the equation there on that. So, but having said all these things, most likely you're not going to hold them all the way to expiration. I didn't put that explicitly down here. Usually we're going to exit after our period of concern, and we're not going to hold it all the way to expiration. And even though you can be assigned early, the earlier you get out, probably the less likely that is a scenario. That scenario is going to happen. Okay. Ted in the chat said, I use this strategy once to defer large capital gains. Okay. From December to January. That is exactly a reason why some people, and I'm not a tax advisor, so I can't speak specifically that, but wanting to, for your tax purposes, maybe you want to maintain that stock. This is a particular strategy there. Okay. So let's get out of this. I can't send this out, but you're welcome to, write it down or take a screen, whatever you want on that. That's basically complete on that. But here's what I want to do. Let's kind of build the foundation on this. And for this, I'm just going to start with a company that everybody knows. I'm just going to pull up Apple. Okay. Let's look at Apple. And what I want to do is I want to go to the Analyze tab on Apple. And I don't want to look at that. We have an existing trade in there, but let's say we were, well, let's go to the Monitor tab. No, Trade tab. Let's go to Trade tab on Apple. I'm going to go out and say we were going to do a covered call on Apple. So covered call on Apple, I'm going to go out of the money a little bit. I'm going to go about to the 210 strike. That's about a 39 delta on that. Remember, delta tells us how much the option moves in relationship to a $1 move in the stock price, but it's also going to kind of give us an idea of how far out of the money or in the money it is. Here, it's a little bit out of the money. And what is the benefit? How much protection does a covered call afford you is my question. How much protection does a covered call afford you? Well, look, if we sell this for $385, that's about as much protection as you get on this, $385. And you may go, Well, $385 is a fair amount of money. That's great. But for 100 shares of stock, that's a $20,000 plus purchase of stock. When you consider $20,000, $385 really isn't that much protection, is it? Okay, so that's one reason why we don't just use a covered call for protection. How much gain do we get on that covered call? Well, if I do the covered call, I make $385 credit up, I bring that in. And then it's kind of just whatever the stock does, but the downside is we cap out our gains at 210. Okay, so there's pros and there's cons with covered calls. Let's consider a different scenario. Let's look at a long put, a protective put. Again, I'm going to go to, I'll go to the same expiration date, July 3rd. And let's go to, I'll go out to about a 34 delta on this. Long put, it's going to cost me $365. How much protection does this afford? Okay. How much protection does that afford? Well, the answer on the cover call, as George put in the chat, was cover calls don't offer you much protection. What about the long put? How much protection does this afford you? And the answer, what is the answer on that? Well, we're buying it for $365. Remember, that is money that can go away. Time decay is going to be working against you. Say it's a negative theta trade. Okay. A long put is a negative theta trade. $10 a day, it's working against you. But it offers a lot of protection in this sense. If the stock goes down, say, to $190, how much is this put going to be worth? Well, at expiration, that put is going to be worth about $10. In other words, about $1,000 worth of protection. Let's say the stock went to 180. How much would that put worth? That put would be worth about $20 or about $2,000 after you use that 100 multiplier on it. The more the stock goes down, the more protection it offers. So with protective puts, if it goes down a lot, it's a wonderful thing to help you out. If the stock kind of goes sideways, that time decay doesn't help you out there, okay? It doesn't help you out. Where's our kind of break-even point on that long put? Well, if it's a $200 put and it costs us $365, our break-even point on the put at expiration is $196.35. I think I'm doing my math right there on that one. So that's kind of your tipping point on that. So, but what if we do them both together? Okay. Mark said, at expiration, the put is worth the difference between the stock price and the strike price. It's worth basically the intrinsic value there. That's how much it's worth. But remember, we're paying this amount up front. So you got to factor that in the equation as well there. Okay. Good comments, everybody. I appreciate you. Now, so covered call, we have it caps your gains. Covered call caps gains. It brings in an income. It brings in a credit. Okay. Instead of income, let me write credit. It is positive theta. Time decay helps you out on it. Okay. With a long put, it helps to protect downside. It doesn't necessarily protect 100% of the downside. I'm not saying that, but it can help to protect downside. It's a debit transaction, and it's negative theta. Okay. So when we put them both on together, the theta is probably largely going to cancel one another out. The credit and the debit is largely going to cancel one another out. We are still going to cap our gains out, but we're also going to protect our downside. That's the net result of the collar. The collar is this plus this, the covered call plus the long put. Okay, so let's look at more of a kind of a example that we use perhaps in this portfolio. Okay, so let me go to the monitor tab, and I have some stock here in here, including CNP. I have 100 shares of stock. So if I'm worried and I want to protect this, I can do that. I also, by the way, have, well, this is a covered call I already have on that. We'll talk about that in a minute. Let's start straight up CNP. So let me go to the Analyze tab. I'm going to go to CNP. Actually, let me go to my chart. Here's CNP. Had a nice trend, kind of going sideways. I don't know, is earnings, when's earnings on this guy? Not till the end of July. So we got a while. So it's not really an earnings issue here on this one. But let's say maybe it's the capital gains thing or whatever it is. Or, you know, I'm not going to get into taxes here. Maybe there's some reason you don't want to sell this. You think maybe it's going to go up longer term, but you're just kind of a little bit worried in the shorter term. If I go to my Analyze tab and I go to my risk profile in CNP, this is what it looks like. This is a typical long stock risk profile. Okay, fair enough. The more the stock goes down, this is the underlying stock price down here. The more money we lose, that's the purple line. The more the stock goes up, the more we gain. The purple line goes up. Fair enough. Let's throw in a simulated trade here, though. Now, we don't have weekly options on this contract. Not all stocks do. Here's CNP. Remember, we got to think, where am I going to cap my gains out on this? Okay. Stocks at 36.60. Okay. Stocks at 36.60. If I do the 37, I'm kind of capping my gains at the 37 level. I'm just going to click on the bid price here because I'm going to sell that call. This is the call side of the equation. I'm going to sell that call right there. Covered call, what does that look like? This is what it's going to look like with the covered call. We're capping our gains out. Where does it peak out? Right here. It doesn't get any higher than this because that's where my covered call strike is. Okay. But is it really offering me protection? Well, not a lot. I mean, our stock is here, so it helps out a little bit. It moves my break even from here to down there. Well, actually, hold on. Sorry. Well, I'm not buying the stock right now. I already have the stock. It does move that break even a little bit by the amount of the credit. So, but let's do this. What if we throw in a put here? Let's go down to our put and let's put in that $36 put. Now, this is where the protection kicks in. We could have the protection go in lower. You know, often on protective puts, kind of a guideline we'd use in this class and some other webcasts is we'll look for something like a 30 delta. Trying to balance, okay? Trying to balance the cost of the trade. The closer you get to being at the money, the more expensive the protection, so to speak, is, versus the amount of protection. If you go out farther, go farther out of the money, it's cheaper, but your protection doesn't really kick in quite as quickly. So we added that. Now let's look at what the risk profile looks like. That looks a little bit like a long call vertical or a short put vertical or something like that. That's what a collar looks like. My zone here is between 36, that's my long put, and 37, because I chose to put these pretty tight together. That is my short call. Short call. If the stock drops, I could potentially lose a little bit, but I've already have some gains in this stock. Right now, I'm up like 382 on this stock. And if it goes down, what's the scenario? What happens if it goes down? Well, if the stock goes down quite a bit, 10%, I've lost a little money there. But that's certainly not, that's like $40 on that. What if the stock goes up 10%? Well, if it goes up 10%, instead of making $400 almost, or for $360 or whatever on that stock, I'm only going to be making about $50 on that stock. There's very clear pros and cons to that. If you think the stock's going to go up, and if it's a long-term hold and you just think it's going to keep on creeping up, you would not want to do this because we're capping it out. Okay. So there we go. That's that. Now, if I want to enter that trade, I can do that. Let me go here and just show you. I can just go to the trade tab. I got CNP, and I can do the same. What did we say? We said, I already own the stock, by the way. Okay. Here's my stock right down there. I own shares of that stock. I can sell my call. I can buy my put. I'm going to hold down my control key. This is a trade I'm layering on there on CNP. And the cost? Well, the cost is largely neutralized. It may give me a little credit. Maybe it gives you a little debit at times. But the cost, the call and the put largely offset each other. Okay? And you can kind of view that when you're looking at your option chain, and you're looking down here, and you go, well, I'm looking to sell this around 85. I'm looking to buy this around 75. You can kind of keep an eye of how much this is. That's my credit, and how much my debit is. And you can try to kind of match those to a certain extent. Usually it won't be perfect. Maybe a small credit, maybe a small debit. In my mind, that doesn't really matter that much. I'm going to confirm and send, and then I'm going to send that order. Now, let's see what it looks like on my monitor tab now. So here's CNP, okay? Notice I don't see anything on here. It dropped in the unallocated area there. So how do I get these all matched up together? A happy family again. How do I do that? Well, what I usually do is I just click on this and I unallocate this, and I'm just going to go to unallocated, and now they're all going to be together. And then if I want to move it back to a group, let's say I want to move it back to this group. If I right click on CNP, I can move to group. I can then go and add it right there, and they should all, in theory, move together. There they are, all sticking together there. That's my caller on CNP. Okay, let's look at questions, and we'll look at another example. Beauty at its best. Would you set a stop loss? No need to set a stop loss on this because it's kind of, you can. I don't want to absolutely dismiss it, but in this case, remember when we're looking at this, we are. Hold on, I've got some extra trades in here. We're already protecting. So the purpose of the stop loss is to protect us from a loss. In this case, it was like $50 difference or something like that. So nope, you can just let that sit. Now you can also do the same thing on. You can also do the same thing on stocks that maybe you already own. Maybe you have a covered call on it. Why would you choose to change a covered call into a caller? Well, first of all, let's look at Bank of New York Mellon. I have this here. I have a covered call. I've got 100 shares of stock. They were just bought in two different groupings, so 30 and 70. I've got the short call. I originally sold that call for 227. Right now, the mark on this is about 45 cents. That is, we've made most of what we can make on that covered call in terms of the call portion of that covered call. And you can see that $182 right there. The challenge is, best case scenario on this call, the most I can make on this is 45 more dollars. 40. So I've made most of what I can make on that. So when I'm in a cover call, when traders look at themselves in a cover call situation and they've made most of what they can make, especially if we're only 14 days to go till expiration, what you may consider doing is rolling that out. Okay, you can roll that out. Well, rolling, it doesn't save you commissions. And essentially what we're doing is we're buying this back and selling another call, but we can also use this opportunity to convert this from a just a plain cover call to a collar situation. It just depends on what you want to do. By adding in versus just doing a cover call, I'm taking away some of the benefits of that covered call. That positive theta is going to go down the tubes once we add in the long put aspect of that. Okay, that's the downside. The nice credit we had, it's probably going to be pretty neutral there. It may even be a small debit at that point, but we're going to add in a lot of protection. Bank of New York, now often this will be done before earnings. I think we got about a month before earnings here on Bank of New York Mellon. So we may be a little bit early on this. Earnings on, well, I guess we got a little bit more than a month, July 15th here. But a lot of times we'll do this right before earnings. The thing is we're just past earnings season here on this. But let's do that. Let's roll out our call. What's the most appropriate date? Well, I want to go past earnings on this. We're going to go past July 15th on this. So let's look and see what we got here. First of all, I'm just going to exit out of this call option. Here's my position. I'm going to, well, let's do this from here. I'm going to get out of this. A lot of times when we roll, we'll just kind of roll and create a rolling order. You can do that, not necessary. You can just close that order and get out. Okay. Firm and send. We had a nice little profit on that call portion of that. Of course, sometimes that means you're not doing as well on the stock portion. And perhaps for the time period that we held that call, maybe the stock didn't do very well, but the stock overall is doing okay. But we're going to try and protect our gains on that. And so I'm going to look for this past earnings, which we said was July 15th. So June 20th is not going to cut it. July 3rd isn't going to. I'm going to go to July 18th here. I'm going to go to July 18th. Where was I? July 18th. And I'm going to look for my call and my put. Maybe I'll look to give myself a little upside here. We got a 95, 92.50. That would give me a little bit more room on the upside if I sell that. That's about $1.05 credit. I could do this right here, 85. I still have some downside here, about a little over 5% on the downside, but that's still protective. These two are largely going to offset each other. My theta is going to largely offset each other on that. Let's take a look at it, okay? So let me get out of my little drawing tool. I'm going to go here and I'm going to go to the 95. We were going to sell this guy. We're going to go to the 85. We're going to buy this one. I'm going to hold down my control key. And let me just analyze this trade. You can analyze the trade, by the way, and put it layer it kind of on top of the existing trade you have. So down here on our Analyze tab, I have the 100 shares. This is a paper money account, of course, but I have the 100 shares of stock that we've already made some money on this. We're doing okay on that 100 shares of stock, but this is what it's going to look like once we throw on that collar. Now, I can uncheck and say, this is what it looks like right now. Notice the more I go up, the more money I make. The more I go down, the more money I lose on that. Let's compare that once we throw in that collar. Look what happens. Once I go down, this flattens out. It doesn't get any worse. It doesn't get any worse than where it's at. Right now, we have about a $2,200 or so gain on this. Well, if it loses, we're going to cut that down to about a $1,700 gain on this. If it gains, well, we're going to cap ourselves out. The most we're going to get is about roughly $2,700 gain on that. So it gives us this nice little range there. And you can see that illustrated if I take the stock off. Again, looks a little bit like a long call vertical or a short put vertical in that regard. Okay, but that's the trade. Let me go to trade. Let me confirm and send. Actually, let me edit that. Let's just look here. Mid price, we'll go here. Just try and get filled on that. I'm going to send that. And we're going to put that in our long stock position. And we now have, we'll see if that lined up as it should have, Bank of New York Mellon. And did we do it? It's a little bit of a mess here because we have our 100 shares broken up into two different. This is the trade we just got out of. This will disappear after we're done today. And here is our new collar on that. It doesn't call it a collar, it calls it a combo, but that's okay. It's the same thing. All right, let me just see if there's any questions. And then, because I want to finish up, but let me just mention, I don't have time, but I was going to go through, if we had time, and just look at Delta. We have this Delta stock. We're doing great on the Delta stock, right? But maybe we want to collar it. I already have a covered call on this. Keep in mind, this is maybe my last reminder on this, okay, is that you have to have at least 100 shares of stock to do a covered call or a collar, for that matter, okay? But if you have more, you can. You're just not protecting it all, okay? In terms of the protection element, you're not protecting it all. You're protecting 100 of the 150 shares in this case. Doesn't prevent you from putting the trade on, okay? You can still do that. You're just not getting full protection, okay? It's not costing you as much either, I guess, from that matter. Let me just scroll up and see. I think we got questions answered. Mark says, my understanding is that it's called a collar because it defines both the ceiling and the floor. Yes. Mark says, so there's really no point in setting it. Yeah, I think we kind of addressed that. Generally, would not be using a stop loss with the collar. This would be kind of an alternative thing. It's not exactly the same as a stop loss. Remember, stop losses aren't guaranteed. You know, if the stock goes down to zero, let's say the stock goes down to zero like that. Does the stop protect you on that? No, not really. The stop doesn't. A collar would help. Collar would help a large extent to protect you on that downside because you have that long put there. All right. Chris says, hey, look, you could do the collar on 100 shares. You could add a stop loss on the other 50. Yeah, you could. Absolutely. You guys are thinking. You guys are thinking through this really well. Thanks, Barb, for helping me on the chat. Thanks, each of you, for joining me today, of course. And let's see. Coming up next, ThinkScripts. Mike Fairborn's teaching that. Appreciate Mike. He's great at that. Appreciate Barb for helping me out in the chat. And make sure you subscribe to the Trader Talks channel so you don't miss future webcasts from us. Everybody, have a wonderful, wonderful weekend. Bye-bye, everybody.